Hi everyone, this is Rishi Kohli from InCred Alternative Investments. I'm the managing partner and CIO for the hedge fund strategies group within InCred. Markets are at a very interesting juncture right now, post the huge volatility seen during and just after elections last week. Markets are taking a breather, trying to figure out which direction they want to move. At this point in time, I think there is a lot of confusion on the near-term direction of the market. From a medium to long-term perspective, there is a lot of bullishness. From our perspective, since I'm more into quant and systematic models, all short, medium to long-term models are actually showing bullishness for the Indian markets. But at the same time, there seems to be some potential cautiousness in the near term, especially given how the markets have behaved over the last 1 year and the volatility seen last week during elections, combined with some seasonality factors going into the end of June and early July, makes me a bit cautious over the next month and a half. So having said this, and combining it with the medium to long-term bullishness of the markets, I think one has to remain long equities in the market for people who are invested into equities or wanting to invest into equities. But there needs to be some amount of hedging or cautiousness for the next few months at least. And post that, I think slightly elevated volatility could continue. Meaning not continuously, but there could be bouts of such volatility from time to time. For the last many years, the volatility has remained very dampened, except for events around COVID and the last week. But I do believe that while there will be periods of that kind of low volatility, as markets further go up, but all these geopolitical and macro issues continue both locally and globally, that will lead to some increased volatility in the markets overall, despite it going up. And another interesting point there is that even in previous bull markets, the best of bull markets actually have had the highest volatility or the steepest short-term declines. So that is something that, we all forget once an event is 5, 10, 20 years past. But something like that I do expect could unfold over the next few years. That while you see overall bullishness, you could see these sharp bouts of volatility or declines from time to time. And therefore, I think a strategy to sort of capture some of those opportunities could be very interesting while being long biased in the markets. And interestingly, at InCred, we are launching a new fund next week from my team, which is called Dynamic Equity Asymmetric Returns, or D.E.A.R in short. And that is actually trying to capture equity plus returns with 1/3, 1/4 the equity market risk. So you almost end up, capturing mid-cap, small-cap kind of returns in the long run, while being focused on large caps and indices largely, but having 1/3, 1/4 the risk of the large cap indices. So it's a very interesting product, which is why we are calling it asymmetric returns, because there the goal is that we capture the strong upsides in the market, more than capture. So we are at more than 100% net exposures in those periods. And when markets are falling, we are at very low net exposures or even negative sometimes, or net short basically. So, you have better compounding over time when you have higher net exposures on the upside and lower net exposures on the downside, and therefore sort of outperform on those big moves up and down. Rest of the times you may be slightly better, slightly worse, or on average similar, but that outperformance in the big moves up and down really help you outperform in the long run. And that is why you get the asymmetric risk return profile, where with lower risk you can actually have higher returns while being long biased. So the average long exposures are more like 90 to 100% range, but the net exposures can range from minus 50%, which is net short, to 190% net long, which is quite aggressive. So I believe strategies like that, and there can be many other strategies with the same flavor, but I believe we'll be one of the few funds in the market doing this at this point in time. But those are the kind of things which, whether through a fund like ours or independently, I would think people should focus on, because over the next few years, I think you will get the equity upside, but with much larger volatility. And even in the next few months, I would be a little cautious. So good time to start implementing such a combination and then really taking advantage of it in the next 2-3 years as the events unfold. That's largely it from my side today. Thanks.